In business, Asia-Pacific markets are under more pressure as worries climb over a prolonged conflict in the Middle East. While checking the numbers at the moment, with Kospi leading the declines this morning, now down by more than 2.7%, followed by Nikkei 225, which is now off by more than 1.5%. Remember, yesterday it was banking shares dragged the benchmark index in Australia lower, and we're monitoring that sector as well, with the New Zealand index now marginally lower as well. And also, core inflation in Tokyo stayed below the central bank's target for a second straight month in March. Fuel subsidies offset the rising costs from a weak yen, but this is said to be temporary as higher oil prices from the Middle East war threaten to boost inflation. Oil prices are continuing their climb in Asian trade, with the Brent at the moment at $115 level, on course for a record monthly rise. WTI just hovering slightly above $106 per barrel level over there. Of course, above the $100 mark. Traders are bracing for an escalation of military hostilities after the Trump administration requested an additional $200 billion in funding for the war. Well, the White House also said the president was considering asking Arab nations to pay for the cost of the conflict. Now, let's bring in Bob McNally, founder and president of Rapidan Energy Group, also former White House energy advisor. Bob, thank you so much for joining us. So you've flagged the risk of further U.S. escalation in Iran, for example, troops taking over Kharg Island. So do you see that ultimately stabilizing oil markets or adding fresh fuel to the rally we're seeing now?
Good to be with you, Henry. Fresh fuel. If the United States occupies Kharg Island, it may or may not do that. There are other smaller islands it may choose to occupy. But if it takes any action that prevents Iran from continuing to export from Kharg, whether it occupies or not, that will probably incite the Iranians to escalate to the next level. And so far, we haven't seen widespread attacks on critical energy infrastructure, terminals, stabilization plants, things like that. But if one way or the other, if the United States ended Iran's ability to export, they would probably retaliate in that way.
So how much of this is already priced in? Are markets underestimating the risk of a more severe supply shock there?
I think they are. We went into this crisis with most people believing it would be impossible for anyone to block Hormuz for more than a couple of days. The U.S. certainly wouldn't allow that. And there was a lot of hope that it would somehow end quickly as it dragged on if President Trump just declared a ceasefire or sort of walked away. But I think that hope is now starting to fade. And I think a more pragmatic and sober view is coming into the markets. We also had buffers, Henry. We had water, oil on the water. We had a release of strategic stocks. There was still oil that had gotten out before the conflict from the Gulf headed to Asia. But all of those temporary buffers are pretty much gone now. And now comes the pain. You're certainly seeing that in Asia, in Singapore, and other Asian countries with shortages. And so I think now it's going to be harder to ignore that this is quite a serious crisis.
Not only oil, we're also seeing spillover effects into other sectors like fertilizers, metals, and broader input costs. So how serious is the risk that this feeds into inflation expectations and ties the Fed's hands?
Well, it is a quite serious macroeconomic risk. As you mentioned, it affects manufacturing, chips, agriculture, in addition to energy. And so we've seen it in the past, many recessions, inflations and then recessions. Since the Second World War, there was usually an oil price spike at the scene of the crime, if you will. And so it's a serious risk. Now then, much depends on how central banks react, how fiscal authorities react. That can exacerbate or mitigate any inflationary consequences. But as an oil analyst, I can tell you, the oil price will continue to rise to whatever levels necessary to enforce the iron law of economics, which says you cannot consume what you cannot produce. And if we can't start producing that 20% of energy that we've lost, we're going to have to consume less, and that's going to come through slower economic growth.
Well, let's say tensions do ease from now on here. So how long would it take for global oil supply chains, to fully stabilize?
I think about 3 to 4 months in most cases. Now, in some areas like the Ras Laffan liquefaction facility in Qatar, there may have been longer term damage to part of that facility. But I think if we ended today, that would be great. There's been no major damage to critical infrastructure. I think it would take 3 to 4 months for Saudi Arabia, Kuwait, a little longer for Iraq to bring their fields back up, make some repairs, and then get the boats moving and so forth. So probably a matter of several to 4 or 5 months.
Well, turning to Asia, which economies are most exposed to a sustained energy price shock?
Well, I think countries that are large importers of petroleum products without stocks, and those are the countries that are most affected. India is in quite a vulnerable situation. Imports the vast majority of its crude oil, most of it from the Middle East, and so it's very vulnerable. But it's not even necessarily just price increases, as we're seeing in places like Australia and other countries. It's shortages. There's just no product, especially diesel, jet fuel, at any price. So it's not just a price increase, but also a physical shortage of refined products.
And what's the policy playbook here? Are subsidies and currency management enough, or do governments need more structural responses?
Well, I'm afraid there's not too much governments can do. They can try to stave off the pain on consumers, and we're seeing that in Asia with subsidies or price caps or blocking exports, work from home, and so forth. I mean, there are certain policies that can attempt to delay the pain, but at the end of the day, with the price of energy rising and physical shortages developing, somebody has to pay that cost. That cost will be borne, whether it's by the government or the private sector. Unfortunately, it's a terrible thing, really. But our economic growth and our standards of living required copious, secure flows of energy. And when you interrupt 20%, there's really nothing you can do to prevent that from leading to hardship. But governments can take some role in trying to mitigate it, spread it, and delay some of the financial costs. But the costs are coming.
All right, Bob, thank you for your analysis. Bob McNally, founder and president with Rapidan Energy Group.